Welcome to On the Mark. I'm your host, Howard Mark Rubin. I am so excited to present this podcast series addressing our rapidly changing world and how it is affecting industries and people in unique and interesting ways. As John F. Kennedy once said, change is the law of life, and those who look only to the past or present are certain to miss the future. The business leaders and personalities who I will be interviewing in these podcasts certainly look to the future. And I hope you come away with information and inspiration that helps you adapt in both your business and personal lives. You can find these podcasts on all major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, getsplatzer.com. Welcome to On the Mark. We have a special guest today, Tom Ravert, who is the author of the book, The Rudiments of Real Estate Home Ownership. And for those of you who don't yet own a home, this could be a very important conversation because Tom will tell you that in terms of estate planning, the most important thing someone can do is have their home ownership, because that's the basis for accumulating wealth in this country. And it has been for generations. So, Tom, welcome to On the Mark.
Thank you. Thank you for having me. This is a real thrill.
Well, if this is a thrill, you haven't had a very exciting life, but okay. But let's talk about why someone should want to own their own home. Why is that?
Starting with it gives you a sense of ownership. It gives you a sense of belonging, having skin in the game. It's a sanctuary. It's a wealth builder. It is it's how you give back to the community, for that matter. People who own their homes tend to take care of their homes better than people who rent homes. It's just the way things are, and it's the foundation of democracy. That's kind of how I see it. So I think that everyone should own a home in some way, shape, or form. And I know there's a lot of talk about affordability these days, but you have to start somewhere. Even in New York, you can find a home for $200,000. I know that's shocking, but there are co-ops and condos that are well below $500,000 in the 5 boroughs. It's a place to start, and based on the way real estate has been appreciating over the years, and with the principal pay down, you gain tremendous equity in a very short period of time. And I truly believe that everyone should own a home at some point in their life.
Well, let's say we have a family of four who rented for a while, and they have moderate income, maybe say $40,000-$50,000 of annual income. Do you think a family like that could somehow afford a home?
Absolutely. I think that, even on $50,000, you can afford a $200,000 co-op. The question is, can you get the unit that you need? My guess is that if you were a family of four, you're probably living in a two-bedroom apartment somewhere in Queens or Brooklyn, and if you're lucky enough to have a rent-stabilized property, a unit, you're probably south of $2,000. If you're not so lucky, you're probably north of $2,000. And if you're able to pay that $2,000, you can certainly afford an apartment. And there are plenty of a co-op apartment. You may not find a home, a single family home, but co-op or a condo is not out of the question by any means.
There are a lot of programs out there. New York State has some other government agencies that are subsidized, I would say, mortgages, FHA mortgages. There are some New York State programs. Can you tell me how that works in making a house more affordable to middle
Yes.
and lower income people?
Yeah, absolutely. So there are down payment assistance programs. The government subsidizes FHA, VA loans. I mean, my son just recently got a VA mortgage. He's in the Army, and I think it was 103% financing.
Wow.
Well, why? Because he's a military person.
So you don't even need down payment.
No, in some cases you don't, and in some cases, depending upon whether there's a bargain to be had, there is the opportunity for no down payment, for that matter. But the key to this is working with a mortgage professional who does this every single day. It's, if someone is I finance a lot of commercial real estate. I advise on residential. And I always refer my residential clients to residential professionals who know the ins and outs much better than I do. And that is the key to getting it done and getting it done right. And the rest is just affordability. My work in the residential advisory world is normally prepping someone, getting a borrower to understand, a client to understand that they need to save, they need to budget, they need to pay their bills on time. You have to bring that credit score up. If they have problems, go to annualcreditreport.com, get a free credit report, find out what's problematic, write a letter, get it cleaned up, and make sure you get that credit score up, because otherwise it's going to cost you more money to finance your home. But there's plenty of money available for homeowners. You just have to take the right step. And of course, the last thing is you have to pay your bills on time.
Right.
That's important. And
But
and
so
and it requires sacrifice. I mean, I've had a lot of clients who you go into their home and they're in some sort of financial trouble, and you see a 68-inch flat screen TV. So it tells me, this is what their priority is. It's comfort and luxuries. And the reality is that, we spend too much money in this country. It's obvious. We overdo it, particularly this time of year. It's
yeah.
probably a guilt thing.
So what I find interesting about credit scores is that I was told that I have credit cards and I shouldn't cancel them, because if I cancel them, that's going to be a negative. Or I have people that I know, particularly young people, who don't owe any money but don't borrow. And because they don't borrow and because they have really very little credit, even if they don't owe money, they're not going to have a high credit score. So you have to actually borrow money in order to have a good credit score. Is that true?
Absolutely, and it's an easy place to start. A lot of times, it's a if you make a $250 deposit into an account, they give you a credit card, and that deposit is collateral for that credit card, and then and that's how you build your credit score. If you pay on time, your credit score goes up very, very quickly.
And how does someone work with a professional like you? Are they paying you on a fee basis? Do you make your money on a commission on the products when they get a mortgage? How would someone expect to work with a professional like you?
Yeah. Someone like me who's a financial advisor, I'm strictly fee based.
Okay.
But if you're dealing with a mortgage broker or a mortgage banker, they typically get a point or two or whatever they get. Sometimes they even get money from the ultimate funder of the loan.
And why would one method be better than the other? Why would someone go to you if they're paying you a fee rather than someone that's just going to take a commission out of the product? What benefit do they get by going to someone like
Well,
you?
this is where it gets a little sticky. Is that we're in the mortgage business,
Right.
so there's an awful lot of shady people out there. So, for instance, you shouldn't have to pay a fee to anyone, including me, for someone to look at your financial statement and or your W-2s and your savings account and say, okay, based on this, and here's how much you can afford. And it's very simple. There's online, Word, not Word, Nerd Wallet,
Right.
and Bankrate. They all have calculators. So these are things that you can do on your own. Where it gets sticky is when you go to a mortgage banker or a mortgage broker, and they say, "Oh yeah, I'm happy to help you out with this, but I'm going to charge you $500 just to look at it," which is it's silly. It's just not. It's ridiculous. The reality is that if the borrower has enough funds, steady income, and they can afford a mortgage, you'll be able to close that loan, and they'll make money on it. So the point is that someone like me, we do the very preliminary work when it comes to understanding how we can help our clients, and then we normally go to a capital source. In the case of a residential loan, consumer loan, we refer it over because we're not residential mortgage brokers. We're just advisors. And that's why we're fee based versus collecting a point. If it was a commercial transaction, we would just charge a fee, a point, that type of thing.
Can someone go online and put in their financial statistics and make a determination as to how much mortgage they were qualified for without going to anyone? Is that something that's available to someone?
Absolutely, it's readily available. It's almost every bank in the country, big bank in the country, has a calculator on their website. It's all free. I think where you have to be very careful is giving personal information. It's not necessary. Well, I'll give you an example. Like, so if you want to know what your credit looks like, you can pull free every year, three bureaus a year from annualcreditreport.com. um, Once you do that, you can look through line item by line item and figure out, whether you made, okay, I see there's a medical bill that I didn't pay from 3 years ago. And then you can look into it and then you can dispute it if you actually paid it. Uh, if you want, when they give you an opportunity to purchase your credit score, uh, you can do that, or many banks offer it as well. Now, granted, my I work, I bank with Chase, and Chase gives me your credit score every time I log on. Now, it's not 100% perfect. It's not like a three bureau report where it gives you a full credit score, but it's close enough. If you see a 700 or north, you're in good shape. If you see a 500, there's just an issue, right?
Right.
It's common sense.
To qualify for a loan at a reasonable rate, what would you say be the minimum credit score you would need?
There is no minimum credit score anymore. There are plenty of uh, non-qualifying lenders out there that will lend to basically anybody.
Right.
However, it's going to cost you more money, and you have to pay because um, if once you go 30, 60 days delinquent, it spins out of control very, very quickly. And I did asset management for the better part of 15 years. We dealt with a lot of clients who either took bad advice from family, friends, neighbors, even some attorneys, which I thought was crazy. And it set them down a path of losing a tremendous amount of equity because in some way they seemed to think that the lender was going to say, hey, yeah, no problem, we'll just reinstate you. No problem. Fortunately, in the consumer world, there are strict regulations and there are plenty of opportunities to right the ship if you uh, start falling behind. People lose their job, things happen, right? Medical issues. But it's important to, number one, communicate with the lender. Absolutely. You get into trouble, you have to communicate. Where people get in trouble is that, you have a $400,000 home and you have a $300,000 mortgage. So you have $100,000 in equity and you start to run behind and then you stonewall the lender, and then fast forward, you're incurring legal fees, the bank advances taxes and insurance, and next thing you know, that $100,000 in equity is gone, and it happens very, very quickly. So that's another role that we serve is that we give a heads up, we get a heads up from a borrower that they're in trouble and they need a little help. They need someone who is, for lack of a better phrase, disinterested, not uninterested, but disinterested, who's going to give them a perspective of, okay, so you have to understand, here are your problems, and here's what the lender is saying. How do we put the two of them together? Because most lenders will work with you to help you get through this. They'll put you on a payment plan. But what happens is, and I've seen this time and time again, people take bad advice, and next thing you know, 6 months, a year goes by, and their equity is gone, and then it's too late. It's
So
like you can't stop.
they stick their head in the sand and just ignore it until it's
Yes.
too late.
Yeah.
So let me ask you about these government programs that are made to make housing more affordable for middle or low income people. Do those programs have the same requirements for credit? Uh,
No, as a matter of fact, they're significantly lower. So they have lower minimum credit score requirements. They have higher debt to income ratios, which is helpful. And normally anything subsidized by the government is competitive rates. So it's there's a great opportunity. But again, I know I harp on it, but the key is you have to pay. You have to keep know your finances, stick with the budget, and make sure that you pay because it's probably one of the most painful things you can see in this business is see someone lose their home.
Now, I remember some old. It's going back to Jimmy Carter's time. We had mortgage rates of 19%, 19 and 20% on home ownership. Um, does and we used what's called adjustable mortgages. We had people that you'd get a mortgage, and every year or 2 years or 3 years, it would adjust either up or down. And those mortgages were cheaper than getting a traditional mortgage that's a fixed rate. Then, when mortgage rates went down to 3 and 4%, people weren't using adjustable rates anymore. They wanted to lock into that low rate. In today's market, do adjustable rate mortgages make any sense for homeowners?
It does. I think the difference between the let's call it the 5-year treasury and the 10-year treasury is somewhere in a range of, I don't know, 35, 40 basis points. If you have an opportunity to if and you can afford it, um, I would lock into a 30-year fixed while you can. There's no prepayment penalty. You can refi at any time. So if rates go down to 2% again, just
Right.
refi, right? Back in the day, they used to have the option arm, which was a negative amortization loan,
Yeah.
which was you were making, you were actually accruing your principal.
Right.
Your loan's actually going up. So I have not seen that product in a long time, but there are interest only loans that are out there as well, and this the market is the capital markets for loans is huge. It's where you have the balance of marginal credit, and you have uh, uh, either um, it's a balance of finding if you have marginal credit and then you're and a very high debt to income ratio where it starts to get sticky because there's a risk factor associated with that. And that risk factor is, well, if your credit score is marginal and your debt to income is high and you've had a job for a long time, but you clearly had some issues in paying bills, there's risk in that, and you're going to pay in a higher interest rate. That's just the way it's going to happen. It's part of the risk, and everything's risk-based pricing. So if risk-based pricing, based on what I've just described, if you're a high debt to income ratio person and a low credit score, you're fairly high risk. So you can get a loan, but it could cost you, north of 7% today, which is that's expensive.
Let me ask you about something else in the mortgage industry it's advertised on television a lot. Tell me whether you think it ever makes sense for someone who has a home who's older, and companies advertise that they're going to give you money. You don't have to make any payments back to them. You can live there for the rest of your life. They can't kick you out of the house, and you're basically living off of your equity. And these companies are funding that and giving you either a lump sum payment
Yeah.
or a monthly check. Does that product make sense for an older homeowner?
I think that depends upon what your estate planning looks like. If you don't have heirs, uh, and and you don't have a pension, and maybe you're living off Social Security and you have plenty of equity in your home, not a bad product, right? Unless you want to leave the home to charity or something like that. But if you have heirs, that's going to be an issue they're going to have to deal with once you pass away. And um, reverse mortgage, it's a nice lifeline, but it's something that I would probably avoid. Uh, but some people need to, right? I mean, the whole purpose of building wealth is that maybe this is something when you get to be 85 years old and you say, listen, you know what? I want a little extra money in my pocket, and I have plenty of equity in a house, and I really don't care about what happens after I die. I'm happy to take it, and I'll enjoy it now, and that's okay too.
Well, I would think it's also one of the benefits of home ownership. If you build up equity, you can use it in your later years, or if you have some expenses, maybe college expenses or some other unexpected expenses, you can get a line of credit and take a second mortgage on it, and you can use that equity as you need it, as long as you use it responsibly, and you can pay it back, except to make it in a reverse mortgage where it's not intended to be back. So I would think that one of the prime benefits of mortgage is that it gives you flexibility in access to more money.
No, absolutely. But the key to any borrowing is you don't pay debt with more debt, right?
Right.
So you have to have a plan.
Right.
You have to have a strategy. And I think this is where probably a third of the population goes wrong is they're like, yeah, I'll deal with that later. But they really need to deal with it up front. I know I'm about to borrow this money. What's my strategy for making sure it gets paid off and and get satisfied? And don't double down when the time comes and keep, tapping into it. That's what happened with the financial crisis. That people were using their homes as piggy banks, and the reality is that they were taking out existing debt with more debt, and it just doesn't work.
Well, but I think it might make sense if someone has a large credit card balance and they're paying credit card rates could be 18, 19%. Maybe they can take a second mortgage at a much lower rate. I don't know what second mortgage rates are now, probably 8%, 9%.
I think a little less now.
Okay, whatever that is, refinance it, pay off the credit cards, and now they're paying at a much lower rate and maybe paying that debt.
Yeah,
That,
but you have to cut that credit card. That's the key.
but yes, but you can't build that up to another
Exactly.
few thousand again.
That's requires a level of discipline, and unfortunately, there's a lack of discipline in this country. People tend to
Right.
spend and spend and spend, and so it
So
has to be paid off at
let
some
me ask
point.
you something else, but related. We have a huge amount, in the trillions of dollars of student loan debt that people have borrowed. And if they're not making a lot of money, will it ever be paid back? I don't know. It's government programs are talking about forgiving some of it, all of it.
Yeah, not me.
If somebody, if somebody has a large student loan debt, does that affect their ability to get a house or to qualify for
It
buying
would
a
be
house?
considered in the back end ratio, which is they're going to consider all other debts, and yeah, absolutely. So they'll go up to. I mean, I've seen debt to income ratios up to 50%, but if you can keep that housing cost to around 28% of your take home, that would be fantastic. Uh, but absolutely, I mean, it's like anything else and I've seen it with my own kids paying their student loans, where some of the rates, when rates were still at 2 and 3%, we were paying 8% in a student loan, which is crazy. But if it's a high interest rate, if you can pay a little extra but pay it down, and remember when you're paying off any type of debt, the note rate of that debt is really your effective rate of return. Why? Because you're not paying interest. You're reducing that interest cost going forward. So I look at it and say, yeah, I'm like getting 8% of my money. Why? Because I'm paying down 8% debt.
So you wrote this book, the Rudiments of Real Estate Home Ownership. Why did you write a book? Why did you write this book?
Huh.
Was it
Uh,
to get rich? Because you don't get rich writing books,
no,
so it's got to
no,
be some other
by
reason.
no means. It's two great motivators in my life.
Yeah.
If someone tells me I can't do something,
Okay.
that's impossible, and out of frustration. And so I've been doing this for 40 years, and I've seen a tremendous. I used to work for a hard money lender at one point,
Right.
and the I saw borrowers who had no clue what they were borrowing. So that was kind of the first trigger, and that was a long time ago. And then I kept hearing every year I either deal with clients or families and friends. They're buying a house, they're selling a house, and so they'll ask me for advice. Sometimes they won't ask me for advice. They'll tell me about a disaster, and and so I had been hearing from a couple of family members that they were quote unquote afraid to buy a home. I'm like, what exactly are you afraid of? Well, the responsibility, all the debt, and the maintenance charge, and maintenance cost, and and then when my son bought a house, and he said, yeah, I bought a house, and he said, well, what do you mean you bought a house? I said, you closed, signed a contract? He said, yeah, I signed a bunch of things. Like he's being a little flippant. He was probably, horsing around with me. And then so I'm like, send me the contract. Contract was a little bit incomplete, and he got through it. And then so with that was the trigger for me. And I was like, I had been writing everything since just down all the crazy experiences being in this business for years. And I dropped everything, and I thought I would bang it out in 4 months, but it took me 18 months to write 505 pages, single space. And then when I brought it to actually both of our friends, Candy Cross,
Oh yeah,
yeah,
sure.
I met her at one of the events
Yes, yeah.
that you sponsored, and she was like, "This is too much. This is a series." And so we've been working on that ever since. But that was the impetus, and it was through frustration with not only with clients, but even working as a lender, working for institutional finance, where I saw people in senior levels didn't know the difference between a mortgagee and a mortgagor. I mean,
Really.
that's a problem. So that was the motivation behind it, and quite frankly, I think I just want to help people out. I want to get, it's very practical. There are some technical things in there as well. People get confused with the difference between cost and value. They interchange these things, or price, cost, and value, which are three distinct different things. Um, I touch on how to look at an appraisal or how to do a competitive market analysis just from a practical standpoint, and then hopefully people will apply this when and be more selective and careful when they do enter into a transaction. Of course, the other thing that's really important to me is working with professionals, and that's across the board: appraisers, attorneys. Like for instance, there are some states in this country, you don't need an attorney
Right.
to buy a home or close. And I'm like, no, you need one no matter what. And it needs to be. It can't be my uncle Harry, who, was a corporate attorney, who's 89 years old. It's got to be someone that's in the game. And I get it. There's a lot of pressure for you to use family members for things like that, but you have to get professionals who are in the game. They know what they're doing. And then the last thing is really about communicating. And these are my wants, and these are likes to have. These are needs to have. I need a 2 bedroom. I'd love a 3 bedroom, but I need a 2 bedroom. So when you deal with a realtor, you need to communicate. Realtors don't want to spin their wheels with borrowers who are not prepared, can't afford, who want to go shopping but really can't afford it. Same thing with the when you deal with an appraiser or a surveyor, title agent. Communication's key. I like the idea of um, having the realtor or the as kind of the quarterback who gets everyone else, working together and communicating. And I'm sure you've seen this before. My own attorney a couple of times, not your firm, uh, came to my second or third closing, and he never reviewed the title beforehand, and of course it was an issue.
Right.
And so, and I wasn't, but it turned into a 4-hour closing for a residential home. Right. This is a classic example of what happens. And a lot of times it's not about pressing these people to do their job. Sometimes it's just about reminding them, say, "Oh, hey, so and so, just could you make sure you look at the title beforehand? Or did you get a chance to look at the title? We're going to go to closing tomorrow." That type of thing. And it's just a little busy. You're busy. I'm busy, and that's what happens. So same thing with the realtor. Realtor is a huge benefit to um, every buyer or seller. Uh, you need that cushion. You need someone who knows how to communicate and negotiate, uh, but you can't follow them blindly as well, because sometimes they don't know, right? So they get themselves into a little bit of trouble. So I cover that in the book as well.
Well, I'm a proponent of the first step someone should do when they want to explore homeownership is that they should go online. They can go to Redfin, Zillow. There's a million sites, and they should look in the area that they're interested in buying, and they should be able to get a pretty good idea by looking at the listings and what's available as to what's realistic to afford. You don't want to go to a realtor and say, "I need a 3 bedroom,
Yes.
unit, and everything is a couple of $1 million, and you want something for $250,000." But you can look online and find what realistically you can afford. I mean, sometimes maybe you get a better deal, a lesser deal, and then once you've done that, then I would go online and see what am I going to be able to pay. A lot of times I suggest to people that they go to a bank and get pre-qualified because that's a big benefit to a particular seller if they know, because instead of a mortgage contingency, they know that these people have pre-qualified and they get a mortgage for $500,000, whatever that number is. And in the leverage, in terms of making an offer, that's a powerful tool to have. Once you have that in place,
Yes.
and at that point, I tell them, well, now go to a realtor who's knows that area, because you want a realtor that knows particular area. I think the a mistake that people make is that they, just like you were talking about finding a lawyer who is your cousin or someone else, you know someone who's a realtor, but isn't a realtor in the area that you're looking to buy, is someone that you know from something else.
Yeah.
So you want someone who's familiar with the area that you know.
Intimately familiar.
Yeah.
Yes.
What do you think of that kind of sequence? Do you agree with that, or do you
No,
think that's
absolutely,
wrong?
and
Or
that's covered as well. So the sequence that I kind of use is go online and look at your own budget, look at your pull your credit report. You know what debt you owe and what you don't, and figure out a plan to get that stuff paid off. Make sure you build your credit score. From there, go online to, like I said, NerdWallet or any bank, and you can just plug in the information. Here's my income. Here, how much can I afford based on where rates are today? It's all available, easy to use, and they also have helplines. So if you need help, there's a mortgage consultant just waiting to help you out. Happy to help you. And then from there, exactly what you said. If when it comes to neighborhoods, this gets a little. It's this is also a little bit dicey because I mentioned someone the other day. I said, "Oh, my daughter lives in Bed-Stuy," and this is someone in Connecticut who used to live in New York.
right,
They haven't been in New York in a long
right,
time, and she goes, "Oh, Bed-Stuy." I said, "You haven't been to Bed-Stuy. Bed-Stuy it's
yeah,
a fantastic neighborhood. It's not what you think it was 30 or 40
right.
years ago, right? It's really
I can,
it's exactly." And so um, when it comes to choosing the what you can afford and your neighborhoods, it's a combination of the two. So sometimes you can't, like, I live in Greenwich, Connecticut. It's you have to find the right section of the to
right.
buy in order to, I'm not
If you have $250,000 to spend, you're not finding something in Greenwich, Connecticut.
exactly.
Look
Yeah,
somewhere else.
and so one of the items that I talk about is, if you're not familiar with the neighborhood, you need to walk the neighborhood. This is where lenders go wrong. Any lender who comes to New York from the outside, and they come to New York and they want to lend in New York, they have a tendency to drive the neighborhoods. You don't understand a neighborhood by driving the neighborhoods. You have to walk the neighborhoods, go there at different times during the day, have dinner, have lunch, walk your dog there for that matter. And this goes hand in hand with due diligence once you figure out the house you want to buy. And I'd like to say you'd be pleasantly surprised how things have changed, because there may be a stigma with a certain neighborhood. Someone may say the same thing for Red Hook for that matter, and then they get there and they realize, wow, this is fantastic. I love it. And again, a lot of that has to do with part of the thing with bad advice. But yes, you start with the with Zillow, Redfin, Realtor.com. It's you can narrow it down, and from there, then you can go see who's a local realtor, and don't be afraid to ask for references, but call the references. It's not a big deal. And quite honestly, if someone asked you, could you give me a reference for your law firm? You can do it in a second, right?
Sure.
That would be easy. Well, it should be the same way with realtors.
Although I don't know, my opinion, I don't know how valuable that is, because I'm going to give you a friend of mine or someone that I've been representing for
Well,
30
there's a
years.
series of
There may be
questions.
someone else that's not so,
Exactly.
who are you going to get
Yeah.
as a reference?
Well, I'll give you an example. So one of the questions I suggest is, how do you deal with conflict resolution? I mean, tell me. I mean, have you ever run into a situation where you have a buyer and a seller who are just standing their ground and they're $50,000 off on a purchase price?
Right.
What do you do? And just let them talk, and you can figure it out. Most people
Right.
have good judgment.
Yeah.
But I would say a realtor who's not willing to provide a basic reference is kind of a non-starter. And of course, you can check for complaints. But again, I'm an advocate of using realtors. Absolutely. I am not a believer in doing it on your own. I think it's a big mistake, really a huge mistake, because people, we're humans, and when you're dealing with other humans, you have one little rub and people get, themselves bent out of shape.
Well, how do you feel about someone buying at the foreclosure sale or something that's what I call off market that's not listed because brokers are basically, for the most part, showing properties that are listed on a multiple listing
Yeah.
service. Are there better deals available by going to a foreclosure market or the off market? Is that something that
You
a
know,
new homeowner should, potential new homeowner consider?
Uh, Absolutely. Off market, I love that market because that's where, because someone who's owned their home for 30, 40, 50 years, um, they hear a lot of noise about values of homes, but it wouldn't be out of the question for them to be off by a couple $100,000. Wouldn't it be nice to buy a house and have a couple $100,000 in equity on day one?
Be great.
And the realtors who work the local neighborhoods, they know. They know, they have their finger on the pulse of the business every single day. And so once you have a trusted realtor to work with, if you give them your criteria and you're ready, willing, and able, of course, it's a great idea, because when it happens, it's going to happen quick.
Right.
If not, they're going to buy
Right.
it. Right? In terms of foreclosures, short sales, REOs, again, you need professional guidance on that. When it comes to a short sale or an REO, you have to do.
Can you just, not everyone knows
Oh,
what a
okay.
short sale is, but
Okay.
can you define what you
Yeah.
what
So a short sale is when a property is being sold for less than the existing loan amount on the house. And normally, a bank is in the business of lending money and getting interest on their money and getting their return on their investment. They're not interested in owning real estate.
right,
So when it comes to short sales, um, the value is what the value is. If the
right.
borrower can't pay it, you can't squeeze blood out of a stone, right? So banks are, they use common sense about these things and say, listen, we've done an appraisal on the property. The property's worth uh, less than the mortgage.
Mhm.
Let's just make this accommodation and give this borrower the opportunity to,
Walk away.
right the ship. Yeah, and walk away, get
Right.
whatever. And when it comes to REOs, which is real estate owned, or it's the REO, other real estate owned. It's not real estate that the bank actually owns. It's real estate they've taken back. Uh, Same process. There are bargains there as well. Some banks are better than others when it comes to selling them. Most will do basic repairs to make sure there's no health and safety issues. Sometimes they'll even hold paper. They'll give you a mortgage because they're just exchanging, one bad borrower for a good borrower. And sometimes they'll even leverage it up, but that's on a case by case basis. The issue there is that it may take some time to get approval at the whatever board level in some cases for a bank, but there's absolutely bargains there. There are a lot of ways to get bargains. It's off market is that's one of the best. There are properties that were listed and they pulled them off the market because they weren't getting any bites. But meanwhile, the seller's still feeling that pressure, and
Right.
they have a tendency to just like, okay, enough is enough. And then they're willing to work with you. I just want out of it. That's it. So absolutely. Again, if you work with professionals, the local realtors, these people will help you out with it. And for them, it is literally a note sitting on their desk that says, "That's what this is. This is a buyer." And once they see it come across their desk, they'll be like, "Oh, let me call Tom." Right?
So I have a different opinion as to foreclosures because when someone who's not an experienced real estate investor is buying a foreclosure, a lot of times they don't realize that, first of all, it's going to be their obligation if someone's living in the house to get them out. They may not get possession. Most of the time in a foreclosure, if it's occupied, you don't get to see the inside of the house. So you don't know exactly what you're buying. You don't know the condition of the house. And it's a risky thing that is something that's, I think, best left for real estate investors rather than a new homeowner, even if they could get it at a tremendous bargain that
Yeah.
might be attractive to them.
I'm completely in agreement. It's the reason the first thing I said was you have to deal with a professional, someone who knows the ins and outs. Even your local realtor, if they haven't dealt with a foreclosure before in the past, they're probably not the right realtor for you to work with. And that I'm just being honest about it. But there are people out there that do this every single, particularly in the boroughs, as you can imagine. And this is what they do. This is their niche in the market. But absolutely, the level of due diligence that you have to do, proceed with caution for sure.
So, if someone needed assistance and needed to wanted to contact you for assistance the more, how should they? What would the best way for them to contact you?
Oh, my information is readily available on pathwaycapital.com.
Okay.
Yeah, I'm happy to help out in any possible way. This is what we do. But we have an interesting business because this is the kind of the advisory arm. We have a lending arm as well that we work
Right.
on, and Glenn Thomas, who's the
Yes.
foremost expert on middle market and ABL financing, so he is my partner in that business. Um, and this is what we do. We want to help people. We want to work with good people, and that's why we work with you guys.
And the book. If someone wanted to get a copy of the book, could they go on Amazon or how would they get
Amazon,
a
and there
copy
it's
of the
it's at
book?
Barnes and Noble. It's readily available. Yeah, yeah.
And you get
Candy took good care of me.
you took good care of you can get the book readily available.
Yes. Yeah.
Okay. Is there
Yeah. So
anything else before we're closing up now? We're about at the end of the podcast. Is there anything else that you want to emphasize that you think people should be aware of and know when they're looking to buy a home that we haven't covered? Is there anything else that you?
most important thing is to take unsolicited advice with a grain of salt. One of my frustrations in this business were you have an aunt or an uncle who bought a couple of houses and they've done very well, and it was just potluck, sort of just the way things happen. And then they pontificate somehow, and they're telling everyone how, because it's human nature, right? You're gonna brag about your wins, and
Right.
let's not talk about the losses. So, and I get it. However, you really do need to take that stuff with a grain of salt, particularly if it's unsolicited. And I hear it all the time. I've heard some crazy stories where people said, "Nah, so and so said it was just fine," and next thing you know, I can't believe it was so difficult to get a mortgage. Yeah,
Well, the for those who qualify, I do stress they should examine government programs and mortgages, whether it's FHA or VA or other state programs for lower income people. And they may not have felt they could qualify by just going on and seeing how much they qualify for if they can get a loan with little or no money down and a lower interest rate. And that is available to a lot of people.
absolutely. I have a step-by-step guide, and like I think it's chapter 3 in
Right.
there, that kind of walks you through all the steps you need to take to do it in a very um, easygoing way.
Right. 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 Well, Tom, thank you for being on the
Thank you.
mark.
This was great.
And I think people have got a lot of valuable information, and I think it was a something that be very useful to a lot of families, and it emphasizes the importance of home ownership in your planning,
No,
your
thanks for
wealth building planning, which is very
Yeah,
important.
that's really important. It is key. I think that anyone that I speak to that's owned a home for even 5, 10 years or longer, they are so grateful that they bought a home. And like I said, I see it as my sanctuary. If I
Right.
want to hide from the world, that's where I hide.
Well, thank you for listening to this episode of On the Mark. I hope you felt it useful, and we'll see you again soon.
Yeah,
Thank
thank
you.
you,
Bye
Howard.
bye. I hope you enjoyed this episode of On the Mark. I started this podcast by quoting John F. Kennedy and would like to end it with quoting one of my favorite baseball players, Nolan Ryan. Enjoying success requires the ability to adapt. Only by being open to change will you have a true opportunity to get the most from your talent. I wish you success in staying ahead of the curve instead of behind the 8 ball. Thank you for tuning in.